So I'll share with you the handouts on reconstruction and reorganization. But before I start taking you through that handout, you need to know what you are going through about. So when we talk of reconstruction and reorganization, a company is in financial distress. When a company is in financial distress, two options: close down, cease operations, or downsize the operations, then see how to continue. Even so, where you want to close down completely and cease and you stop the operations kabisa, that is called external reconstruction, where a company is being liquidated. But where you are in financial distress, but you want to see ways on how to continue with operations, that is called internal reconstruction. It happens from day to day in Afanyikanga. So our main concern here is to check how can you advise a company where they are in financial problems, but they want to continue. How do you advise them? Two, how do you liquidate a company which is in financial distress and they don't want to proceed, they just want to liquidate and go. So that's what we want to check. Mmeshapata hiyo topic. So let's just go through these notes for further understanding. Reconstruction and reorganization. Reconstruction and reorganization of capital structure refers to the rearrangement of the company's capital structure, including reduction of the shareholders' capital and creditors' balances. So shareholders, unaongea na wao, unawaambia, you guys, our shares are very expensive in the market. Look at even the par value, shillings 10 each. Let's reduce these shillings 10 to shillings 2 per share. We make them affordable, we take more shares to let a person. Creditors, you talk to them, you tell them, we were supposed to pay you after 2 months, please give us more 10 months so that we can be able to pay. So where you are in financial distress, but you are negotiating for prolonged credit period, you are also trying to negotiate with the shareholders to reduce the par value of ordinary shares. You know, the moment they reduce, it means they can subscribe for more shares. By subscription, they are bringing more funds so that we can proceed. Such arrangement of capital structure becomes necessary, especially where a company has been operating at losses over a long period, or when a company is in financial distress or difficulties, the way I've said. Types of reconstruction. Types of reconstruction. We have two: internal reconstruction and we have external reconstruction. So let's start with number one, internal reconstruction. The capital structure of a company is reorganized internally with the entity retaining its legal identity. So you just reorganize, unapanga tu internally. Let's reduce this, let's adjust this. Let's talk to the bank, let's do this. So if you reorganize yourself internally, then such kind of reconstruction is known as internal reconstruction. External, this is where a new company is formed to take over the operations of an existing company. So you form a new company with the sole aim of taking over this particular company. But now the old entity must be liquidated. The selling company is liquidated after selling its business operations to a newly formed company, I've said. Further aspects of internal reconstruction. So I want to check much on internal before we go to the external reconstruction. So further aspects of internal reconstruction. It is carried out without liquidating the existing company. That one you have noted. The company retained its legal and distinct identity. The process of internal reconstruction must be authorized through a court order, correct? Wherever in the world. From your company law, hapo nyuma, muliambiwa you cannot alter the share capital of the shareholders without, hata ukiangalia mkitaka kuinterfere na CR12, si kitu serious, angalia kifungu hapo. When you want to alter the CR12, even there is how do we call those things? Affidavit which you have to swear, a lot of stories. So for you to alter, because you know during internal there is alteration of share capital per value. Unasema from 10 let's tuweke huku if so there must always be a court authorization for you to alter the share capital of the shareholder. That one you studied in law, correct? It involves alteration of share capital, variation of shareholders' rights, reduction of par values of shares, and surrendering of shares. Capital reduction normally takes place when the entity has been reporting successive trading losses and the shareholders' capital no longer represent the net worth of the company. Hiyo tumekuwa tukisema hapo. MB, to effect a scheme of internal reconstruction, a special account known as capital reduction account should be prepared in order to determine goodwill or capital reserve arising from the reconstruction process. This account is maintained by the receiver. So receiver is the one who is in charge of internal reconstruction. You know, Chase Bank, Uchumi, and the rest. When they were in financial crisis, you call a receiver. So the work of the receiver will be to reorganize the company to the profit lane. Once it is reorganized to the profit lane, then the receiver now will hand over the company to the management once now they have started realizing profit. But sometimes the receiver comes and still it can't work. So if that is the case, then now you will just have to propose external reconstruction, which will come later. So the work of the receiver, you know, sometimes we are dealing with human beings. They will come to receive, but they receive in their stomach. Wewe unafikiria mmeleta mtu hapo kuwasaidia, yeye kumbe anapanga lakini anapanga kwa tumbo. So for accountability purposes, the receiver must also maintain a special account known as capital reduction account. I want to take those ones very clearly. Capital reduction account, so that any adjustment, any proposal which has been made must pass through that account known as capital reduction account. That is the main account which is being maintained by the receiver. Correct. External, CLE external. I'm not going to external reconstruction first. So internal, from there, now let us go straight. Internal reconstruction, simple. Reorganize internally where you negotiate with the shareholders to accept reduction in the par value of shares, negotiate with creditors to accept prolonged credit period, negotiate with bankers, maybe also to accept prolonged loan period. Then the process is carried out by the receiver after the court approval. And the receiver, all the transactions, though not all, but most of the transactions will pass through an account known as capital reduction account. The balancing figure in capital reduction account can be goodwill or capital reserve. But in most cases, you find that account balancing automatically because you have tried to reorganize. Hakuna story mingi. Let's check an illustration. I would wish to start with a very old question. In November 2015, last semester tulikuwa na kitu internal hapo, lakini ilikuwa inaeleweka. Hiyo ndio tutamaliza nayo kwa internal. So let's meet in November 2015. Question 2. November 2015. Question number 2. I'm already there. Please, someone who has gotten the question, can you tell us the page? Someone who has gotten the question, can you tell us the page? Page 136. Higher. There we go. It says, so this is November 2015. Question 2. It says, 2B, Tabu Limited is a private company. 3/4 of the issued share capital of the company are held by the directors and members of their immediate family. The company's draft statement of financial position as at 31st December 2014 was as follows. So intangible assets, we have development cost goodwill. Tangible, we have building, plant and machinery. Current assets, inventory, trade receivables. Current liabilities, we have payables, bank loans and overdrafts. Ordinary share capital, share premium, accumulated losses there. Bank loans and overdraft consist of 10% loan or shillings 400 million carrying a fixed charge on the company's buildings and an unsecured overdraft of 287 million. The demand for the company's product has fallen drastically in the recent years, owing to the importation of high quality and cheaper alternative products from Southeast Asia. The development costs appearing in the statement of financial position relates to a new product that has been perfected to a marketable stage and for which there is believed to be a strong demand. These costs have been properly capitalized in accordance with IAS number 38 intangible assets. The company is in urgent need of capital to meet existing liabilities and the necessary new investments in plant and working capital. A scheme of reorganization has been drawn up for consideration by shareholders and creditors. The terms of this scheme are as follows. Okay. Number 1, the shares of shillings 10 each are to be written down to shillings 2 per share. And subsequently, every 5 shares of shillings 2 each consolidated into 1 fully paid share of shillings 10. The existing shareholders are to subscribe for a rights issue of 2 new shillings 10 ordinary shares at par for every share held after the proposed reduction and consolidation. A major supplier agrees to exchange a debt of shillings 180 million included in trade payables for 18 million ordinary shares of shillings 10 par value. In full satisfaction of the shillings 687 million owing to the bank agreed to accept an immediate payment of shillings 87 million and to consolidate the balance of shillings 600 million into a loan carrying an interest at 13% per annum, payable in 5 equal annual installments commencing 31st December 2016. The loan is to be secured by a fixed charge on the building and a floating charge on the company's remaining assets. The creditors balance on the share premium, the credit balance on the share premium account and the accumulated losses and goodwill are considered valueless and are written off. The assets listed below are to be restated to the following amounts. Restatement means now those are the correct values. Plant and machinery, inventories, trade receivable. Then we have buildings. A group of dissatisfied shareholders plan to oppose the scheme because they feel they have borne an inordinate burden of reorganization where the bank has lost nothing. The company has received a cash offer of shillings 1120 million for its non-current and current assets. Required, the revised statement of financial position of Tabu Limited as at 1st January 2015, after conclusion of the proposed scheme of reorganization. Then a report to the group of dissatisfied shareholders advising on whether they should accept or reject the scheme of reorganization. So, what I want us to do is first because you know we are not going to have time to do so many illustrations. So this question venye nakwanga, sometimes unapata umeambiwa you prepare journal, hii wameenda so direct. Wanaanza na journal entries, then capital reduction account. Capital reduction account is a very critical account here. So I will want us, first of all, you know, when you are effecting, you are making adjustments. So I want us to come up with capital reduction account. No, before capital reduction account, I want us to come up with the journals. Journals, unafanya tu hivyo wenye wanasema. So we come up with journals, then again, we come up with capital reduction account. Then from there, we can do for them the revised books. In exam, those workings are not necessary. Kama ingekuwa hivi. But because I know that's a frequent question, those journals and capital reduction, let me just come up with them so that you be familiar. So write for me there. Journal entries. Journal entries. Just in case ukutana nayo kwa mtihani. Journal entries. Journal entries. In financial reporting, I told you, any moment you have been told of journal, is just which account to be debited and which one is to be credited. So here, we are going to work in thousands. Like that. So have it that way. All right, there we go. So number one, let's go to number one. The shares of shillings 10 are to be written down to shillings 2 per share. We're going to use subsequently. You know, you are reducing share capital from 10 to 2. Share capital, but then you will just understand the debit and credit. Share capital account. Inakwanga on which side? Do we normally credit share capital or is a debit entry? Ukishaelewa hiyo, we are good to go. Share capital account, does it have a debit or a credit entry? Does it have a debit or a credit entry? Gideon, credit. That is correct. Share capital account has a credit entry. So any moment you are reducing, it means you need to debit the account. When you reduce share capital, debit that account. So you'll come here and say, journal number one, equity shares. Equity shares, it is being reduced by shillings 8 because they are reducing from 10 to 2. So they are reducing by shillings 8 per share. They're reducing by shillings 8 per share. So take shillings 8 times the number of ordinary. So go to the balance sheet up there. Ordinary, it was 800,000 divided by a par value, which was 10. So we had 80. We had 80. So that is 640. So you bring here 640. Then you credit capital reduction. That is the main account here. Capital reduction account. Capital reduction account. Also with the 640. Like that. So because of my space, I want you to narrate on your own. You say, narration, you write anything. Say that but you can say on reduction of equity, par value of equity shares. Just something which makes sense. On reduction of par value, on reduction of equity shares, anything. Then that one ends there. That one ends there. Then they say, and subsequently, every 5 shares of shillings 2 each consolidated into one fully paid share of shillings 10. Hiyo hata hakuna kitu hapo. You know they went to 2. So they will be having 2 times the number of shares 80. So they will be having 160. So they are saying instead of 80 at 2, they will be having, they consolidated them into 10. So they will have 10 at 16, which is still 160. So there is no effect there. Labda hapo mbele. They were, after reduction, it is 2 at 80 at 2, which is in value is 160. But kama wanaibika, wanaona hii tu ni mbaya. So wanachukua 5 of 2 to become 10. So 10 of 16, because they consolidate this one, you take 80 divided by 5, which gives you 16. Then they have a par value now of 10, which is still 160. So there is no change. Let's go to number 2. The existing shareholders are to subscribe for a rights issue of 2 new shillings 10 ordinary shares at par for every share held after the proposed reduction and consolidation. When they subscribe, it means they are paying. Subscription means paying. So when they pay, you debit the cash book. You debit the cash book. So this is a rights issue. And the rights issue, they are saying, on what basis? 2 new ordinary of shillings 10 for every 1. Yes. You get 2 ordinary for every 1. That is what they mean. Times the number of ordinary after consolidation. After consolidation, instead of having 80, we'll be having 16. Because they consolidated, they took 5 to form 1. They took 5 to form 1. So after consolidation, we are having 16. But the 16, they are paying shillings 10. Yes, they are shillings 10 actually. That is what they mean. They will get 2 ordinary through the rights issue, 2 ordinary for every 1 times 16. After consolidation, that's why I'm very keen on it. After they reduced, 1 share was having a value of 2. So they took 5 of them. They took 5 of them to form 1 of shillings 10. That is what they say. So of this 2, they picked 5 to form 10. So how many 5s will you have? You'll have 16 of them because it was 80. They had 80 ordinary shares. But if you reduce them into 1 of 10, then they will be 16. So it is 2 over 1 by the 16, but the par value is 10. What do you get? Being the first question, it might be challenging. What do you get there? Somebody? Someone? Yvonne, that is 320. So this is 320. Then you credit ordinary share capital, equity. Equity shares itaenda juu. So equity shares will also go up with 320. So you can say anything here to recognize the rights issue. This was a rights issue. They are the people who say it. So this one was to recognize the rights issue. It was to recognize the rights issue. Number 3. Let's go to number 3. Let us go to number 3. Number 3, a major supplier has agreed to exchange a debt of 180 included in trade payable for 18 million ordinary shares of shillings 10 per value. So creditor supplier amekubali instead ya kulipwa achukue ordinary shares. So creditors also has a credit entry. When they accept, reduce the credit by debiting. So debit here payables, number 3. That is 180. The debt was 180 million. So that's 180,000. Then instead of being paid, so I've cancelled that debt because creditors as a credit entry. When they accept shares, remove the debt by debiting the creditor's account, then you credit equity shares. Equity shares. You can say anything on cancellation or to cancel the credit or suppliers, anything. Hiyo narration sitaki mtu ashikilie one word. To cancel or to recognize the shares issued to creditors, to cancel the creditors balance, anything. Bora umeandika something relevant. Alright, let's go to number 4. So number 4 here says, in full satisfaction of the 687 million owing to the bank agreed to accept an immediate payment of 87 million and to consolidate the balance of 600 into a loan, carrying interest of 13% per annum, payable in 5 equal annual installments commencing 31st December 2016. The loan is to be secured by a fixed charge on the bill. Hiyo ni story. So bank wamekubali, tulikuwa deni yao 687, wamesema ndio tuwahurumie, mlipe 87 kwanza. So when you pay, you credit the cash book, then you reduce the loan. So debit, bank loan, reducing a liability is a debit. So with 87, then you credit cash book. Cash book also 87. When you make that payment, you credit cash book, then you debit the loan account. You can say on part payment of the bank loan. Part payment of the bank loan. Just anything which makes sense. Hiyo ingine tabaki kama loan, so hiyo ni sawa tu haina shida. Haya, we proceed. Number 5. The credit balance on the share premium account and the accumulated losses and goodwill are considered valueless and are to be written off. So let's write off. Share premium, share premium is equity component. All equity are on the credit side. So when you're writing off equity, it means you debit. So debit share premium account, share premium. Can you check how much was the credit balance in the share premium account? Go to the balance sheet. How much are you seeing? Just confirm. I just want to see how together we are. How much is in the share premium account? Yeah, that is correct. 50. So you debit with 50. Then you credit, the main account is capital reduction. So capital reduction with 50. Then you can say to cancel or to eliminate share premium. Correct. Journal 6. Journal 6 bado tuko kwa hiyo 5. And the accumulated losses. You know accumulated losses, how do we write off accumulated losses? Profit is normally, income is a credit entry. I hope you are aware of that. Income is a credit entry. Likewise, a loss is always a debit entry. That is what you need to know. When you check P&L, profit account, because I'm dealing with accountants, you know this. Losses are normally debit entries in the profit account, while income is a credit entry. So if someone is telling you to eliminate accumulated losses, you should know that accumulated loss, number one, it is a debit balance in the P&L. So to eliminate it, you credit P&L account, then you debit capital reduction. So capital reduction, check the accumulated losses. In the balance sheet down there, it was 232. 232, then you credit P&L, profit and loss, with the accumulated losses. 232. I hope you are seeing it. To eliminate a loss, you credit P&L because it is a debit balance in the profit account. So credit the profit account, then debit the capital reduction. Then you say to eliminate accumulated losses. Number 7. They have also said goodwill was worthless. So if at all goodwill was worthless, it simply means it should be written off. Goodwill is an asset. Correct. Goodwill is an asset. Assets do have debit balances. So when you are writing off an asset, credit that asset, then the main account is called capital reduction. So capital reduction. How much was the goodwill? Check the assets up there. Goodwill was 60. Goodwill was 60. Then you credit goodwill account. Goodwill account also with 60. Narration to eliminate goodwill or to write off goodwill. So it's just knowing those double entries. Ukishajua ni hivyo. Goodwill is an asset. Assets are always on the debit side. When you eliminate an asset, credit the asset account, receiver anakuja anaweka hapo kwa capital reduction. Number 8, which I think is the last one, that is note 6. The assets listed below are to be restated to the following amount. So restatement means they are being adjusted to the correct values. So during restatement, we can either lose or gain. Is a gain or loss, whichever. So if it is a gain on assets, you increase the asset. Increasing asset means you debit the asset account. So debit the asset, credit capital reduction. Vice versa, for the loss, you just interchange. If it's a loss, you reduce the asset by crediting, you debit capital reduction. So to answer, plant and machinery, 125. Can you check the book value? How much was the book value? Book value, where is this? Plant and machinery, Mayona. Plant and machinery in the books, it was 326. In the books, it was 326. Now we are being told to write it down to 125. That is a loss. So the loss, you will credit plant and machinery. You will credit plant and machinery, then you debit the capital reduction. When asset loses value, you credit the asset. So come here and say, capital reduction, because I'm dealing with many assets, I will leave the capital reduction first hanging, then I deal with these others. So plant and machinery, can you give me the decrease, the difference between the two? It comes to how much? Give me the difference. Thank you, 201. So that's a credit. Credit. Let's go to the next inventory. Adjusted to 210. Book value 426. That's another loss. How much? Inventories. Loss of how much? 216. Thank you. Receivables 500. Book value 531. That is also a loss of 31. Correct? Finally, building 320. In the balance sheet, building 270. That is a gain. So hiyo haiwezi kuja hapa. So tutafunga hii, then building itakuwa the last one, number 9. So can you add for me these three, this plus this plus this, all the losses we post to capital reduction. Can you add the 3? Building is again, we can't bring it there. Thank you. I can see people giving me 448. 448. Then finally, number 9, building as gained. So debit buildings. You debit the buildings, 320. This other side, 270. That is 50. That is 50. Then credit capital reduction, also 50. If you want narration, you can write on restatement to restate the fair value of assets, or just on restatement. Your narration is very kitu kubwa, just something small. The main thing there is restatement, to restate those values, period. So in internal, I know them with journals. They like telling students to bring journals. But in this question, if you're doing an exam, I won't require your approach. But I'm bringing the way they normally bring that question fully. They normally start with this journal. So in case they tell you to come up with journals, this is what you're supposed to do. Number 7, wachana nayo. Hao ni watu hawasikii vizuri, they were dissatisfied. Hawataki hiyo mambo ya internal. They said they were dissatisfied. I think they were dissatisfied because wameona number 8, where kuna mtu amewapea offer ya kuuza kampuni at 1120. I think that's why they are dissatisfied. So dissatisfied means they want the company to be sold. They don't want internal reconstruction. So for the journals, this is what you're supposed to do. Then from there, I'm taking you through all the steps. From there, what students are likely to be told to prepare is capital reduction account, is when now you answer the question. So I want you to take a few minutes. We prepare capital reduction account here. capital reduction account. Capital reduction account. So in case we come across a question where the examiner is telling us to prepare capital reduction account, so this is what you do. Sometimes it comes in a question without journals. When you on journals, it becomes easy. The case is going to be very easy. But there are some situations whereby there is no journals, but they want capital reduction account straight. So if that is the case, you do journals offhand. Debit, building, credit, capital reduction. So even when you smart credit capital reduction, you come and credit without passing the journals. But here already we have passed the journals, so hakuna haja kujisumbua. So what I want you to do for me, check journal 1. Check your journal 1, I've deleted. You ask yourself, was there a capital reduction account? Yes, it was there. Check your journal number 1. Capital reduction was there on the credit side, but it was on the credit against equity. Equity is what made capital reduction to be on the credit with 640. So have it on that side with 640. Journal 2, there was no capital reduction. Journal 3, no capital reduction. Journal 4, no capital reduction. Journal 5, yes. Capital reduction is there on the credit with the share premium. Share premium 50 on the credit. Journal 6, yes, on the debit. P&L. P&L, it is there with 232. Journal 7, yes, debit through goodwill. Through goodwill, 60. Journal 8, yes, on the debit. So you name them one by one. Plant and machinery, 201. Inventories, ikusaidie kupata text mingi. Some students wanaleta lump sum kama hii, para usipate hivyo. 216. Receivables. Receivables, 31. Like that. So have that. As far as I'm concerned, we are done. We are done with all the journals. Yes, there is this one. Building capital reduction. So building, the last one, 50. There is nothing remaining. If it balances on this side, then we say we still have goodwill. If it balances this side, it's called a capital reserve. But rarely, unapatanga hii kitu na balance, ufai kuwa na balance, but sometimes it can. So can you add for me? You tell me whether it's balancing or not, or whether it's balancing. Can you check for me that? It is balancing, Yvonne, with 740. Balancing with 740, so that is okay. Last semester walileta internal reconstruction, wanafunzi wamelia. We'll revisit, tutaangalia ni gani hiyo walileta. Finish that. The latest, we can leave this class, the very latest is 8:15. Otherwise, by 8:10, we should be done. If you're giving me answers promptly. Whatever is remaining is hiyo kitu kubwa. So those two have really wasted your time with these two items. but I know why I was wasting your time. They are highly examinable in internal reconstruction. These two, hata ukitembea kwenye past paper, huwezi tembea sana bila kuona, especially this one, capital reduction account. And I'm saying, and I repeat, in some questions, unapata Roman 1 capital reduction without journals. So if you don't have journals, then you generalize offhand. Whatever we're doing here, unasema debit share premium, because umeona share premium inapungua, debit share premium, credit capital reduction. Then you come and credit here with that share premium. So you generalize offhand. Kama unaweza fanya somewhere rough, then unaweka hapo. So take care of that. So let me answer the question. Let's answer the question straight. The question, they want us to prepare a revised statement of financial position. The correct one, after the proposed scheme. So, because of my space, write for me there. Write for me there. Tabu Limited. Tabu Limited. Tabu Limited. Revised statement of financial position. Revised. Tabu Limited is on top. Then up next, the revised statement of financial position. Then the third line. As at 1st January 2015. As at 1st January 2015. So if you're doing this question in exam, where are there two hapo? You will get so many ticks. Ili mapeleka safari mbali because I wanted you to have full sight. So now what we do, revised, we go to the old one. Let's take that format. The ones which were not affected, there are some which were not affected with the journals, you record them the way they were. The ones which were affected, take the new values. Okay, so we start. Non-current assets. Non-current assets, development cost was not affected anywhere. So development cost, this is 85. To the far end, bring it to the far end. So that one is there. Number next was goodwill. Goodwill was written off. You can recall. Wachana nayo. Next, tangible assets, building. Building and any other asset, check note 6. The ones which were restated, now take the restated values. That's another mistake some students wanafanya. Any asset restated, go for the restated figures. So building, go for the restated figure in note 6, 320. So buildings, 320. Then plant and machinery. Plant and machinery, restated 125. You see up there, you don't need any working. Then there is nothing. Can you add? Add for me non-current assets. Add for me non-current assets. Somebody with the figure? $530. Current assets. There was inventories. Inventories were also restated. They were restated to 210. Receivables were also restated to 500. We also restated to 500. Then cash book. There is cash book here. Cash book, there was no cash before. Hakukuwa na cash. But when you check the journals, journal number 2, check your journal 2. you can see cash of 320. And also in journal 4, there is 87. So you will take 320 minus 87. What do you get? What do you get? When you subtract 320 minus 87, 233. 233. Total assets, you take 530 plus the current assets. So can you give me the total assets? Thank you, 1473. So up to that stage, hata kama umesumbuka kufanya hizi vitu, niyo cash peke yake, the rest are okay. I write down there equity and liabilities. So me, I'll go the other side because I'm trying to put a bit hapa. So equity and liabilities, you write down there equity and liabilities. Equity and liabilities. Equity and liabilities. So ordinary share capital. Ordinary share capital. How much was there in the trial balance? How much was there in the trial balance? Yes, correct. It was 800. So initially it was 800. Check journal 1. Journal 1, there was a reduction. It was reduced. It was reduced by 640. So you subtract the 640. You subtract the 640. Then check journal 2. Journal 2, there is equity on credit. Credit to equity is a plus. So plus 320. Check journal 3. Journal 3, equity again on the credits, 180. That is a plus. Journal 4, no. 5, no. 6, no. 7, no. 8, no. Nothing, no. So that is all. So can you add? Add for me those figures. To get equity. And debit to equity is a minus. That is what my students should know. A credit is a plus. Thank you, 660. Proceed with our equity. Proceed with our equity. Proceed with our equity. So under equity, when you check under equity, kidogo tu, just a minute, kuna mtu anasafa mahali. That is done. Okay. Under equity, you are seeing the share premium. Share premium was written off, you remember. So hiyo umetoka. Accumulated losses, we wrote off. So under equity, there is nothing. That's the only item we have. So what you need to bring is current liabilities, but the current, kuna non-current. Kulikuwa na hiyo bank loan and overdrafts, the 687. Remember? I thought ordinary was 80, yeah, 80 in terms of shares, but monetary, it was 800. In terms of value, it was 800. You know, balance sheet now we work in shillings. So 80 times the 10. I hope you know. In shares, fine, but hope you've seen that. So non-current, you know that bank loan lipa 87 na wakasema iende long term. Attracting 13%. So 13% bank loan. It was this bank loan and overdraft of 687, then they paid 87. So it remained 600. That is what remained. Haya, so good. Current liabilities ni moja tu. Payables. Payables 393. Lakini kuna ile walipewa shares. I think ni channel number 3. Check your channel 3. They were given some shares worth 180. So that one you need to reduce. What's the claim? 393 minus 180. What do you get? $213. Total equity and liabilities. So total equity and liabilities. How much is that? It is in agreement with our total assets. $1,473. Yes. Then there is that part 2. Hebu soma hiyo part 2. Na watafutie hiyo solution. Nimepata. So that is how you, so unaona kama ukienda hiyo story, as for that question, you will have only missed cash book and maybe adjustment to ordinary, hii umepata na hii umepata, because it's just subtraction. So those two things are not necessary, but I wanted you to have complete set. So Roman 2, they are saying a report to those people who are dissatisfied. Kuna watu wanaona hii kampuni tusiendelee, wacha tuifungwe tupate hiyo pesa. So I'm sharing with you. I have that solution. Check what I've shared. You can write that one before you sleep. Report to the dissatisfied shareholders. Yeah, you can write that. Then when we meet, we are likely to proceed with, this one, they had already proposed for you. They had already proposed. So we're in finance. What if you are the one who is required to propose? You come up with these things. That's what I'll be teaching you next time, how to propose the scheme. I think that's what they examined in the last sitting. So thank you for your time. Thank you for your time. Have a nice, good evening, good night. We meet in our next class, God willing, on Thursday. Have a good night.